It's a huge day for the markets, and we have with us, should I say hugest or the biggest of market veterans, Raamdeo Agrawal of Motilal Oswal. His team has just completed their 28th wealth creation study, and over the past many years I have noticed each study gives you a gem of a lesson to find wealth creating companies. This time Raamdeo says don't just look at accounting profit, look at economic profit. Look for where sector trends and the company's own endowments gives you a hockey stick return. Now I'm really excited about the hockey stick return. More from the man himself. Raamdeo, thank you very much for dropping into our studio.
Good morning.
Well, first up, look at the ambience where we are meeting. The markets, 2 months back, 5% risk-free return in the US yield. Today it is below 4%.
Is it gone below?
Yes, 3.97 when I last checked. So, should we actually prepare for higher multiples now?
You see, markets are not mathematics. I mean, yes, a kind of a significant reduction in the interest rates would warrant, re-rating in terms of higher P multiples for the stock, which is a logical other thing. But if it is, cyclical upturn, downturn from say 1.5% to 4%, 4% again comes. So this is a cycle. I think stock markets, they are already priced in this kind of movements. Unless this 4% goes to 10%, 12%, obviously the multiples will fall, but I don't think this requires any kind of a major adjustment in the P multiple. So we are at about 22 in India. So if by chance the interest rate comes down to 3.5% or 3%, that doesn't mean that we deserve to get 30 or something like that.
Oh no, not that much.
Yeah.
But I thought one standard deviation higher, even that will help because
somewhat,
if you're going to grow at 15% earnings,
it's a tailwind for business valuations. I mean, how much I don't know, but it definitely is tailwind.
Okay. Now, what has come from the FOMC, the dot plot, they vote on GDP and inflation. They've all brought down their inflation forecast and hence the rate cut, number of rate cut has increased. But they have not brought down their GDP forecast. In fact, for the current year, GDP forecast has been adjusted higher because the last number from US was 5.2. So, therefore, Fed is endorsing Goldilocks, you think?
Of course, they are themselves surprised the strength in the economy despite inflation and whatever difficulties they had. So clearly it's a terrific time for US economy, but India has, despite all the difficulties world over, we have brilliant time. Goldilocks is on in India even earlier than US. So
I think by ourselves we are in a Goldilocks.
Last quarter 7.6% when the world is at 1 or 2%. So the gap between the global growth and Indian growth is distinctly higher this time, and now the knowledge people, RBI and all, they are projecting even next year to be as exciting, and even after that also. So if by chance Indian economy actually grows at about closer to 7% in 24-25, I don't think that's there in the market.
No, that's not priced.
Yeah, that's not priced.
Yeah. They are still talking about 6.5. I want to come to your hockey stick return. As you say in your study, think stocks, not markets. But today, we have to talk markets for a little bit more. Does this look like 2004 to 2007 to you now?
Yeah, I mean, I have seen 4 bull runs. See, welcome to the bull run, okay? We are properly in the bull run. And so we had the biggest of the bull run was 1992, Ashar Mehta bull run, when the market went 7x in 19 months, from 6,700 to 4,200. So that time it was a liquidity-led bull run. There was no support in terms of corporate earnings and all, but it was just a liquidity-led, and liquidity suddenly went out. This time we have the fundamental reason where GDP is growing well, corporate profit is growing at about anywhere between 15 to 20%. Right now my analysts are saying for next 2 years,
24% this year and 14%.
Yeah, so they are saying about 18-19% compounded 2 years growth. So we have a very good support of the corporate earnings growth, and we have an amazing amount of retail liquidity just pouring in, and in a predictable way. My sense, it's a 5 to 10 year kind of run, and grand finale is ahead in the stock market. So we are in bull market, and bull market always ends badly. So be ready for some kind of though we have a fantastic regulator, we have all kinds of digital surveillance. They can always control it. I hope they control it in time. But the size of the liquidity which is entering because of this almost 3 million accounts coming every month. Now we have crossed 130. We are about, I think, 133 or 135 million accounts. Every month it's climbing. My sense is we're heading for 250, 300 million accounts in next 3-4 years. So till this journey continues, I think we'll have enough local liquidity. Now foreigners, they have to decide. They lost 3% share they sold at 16, 17,000, 18,000. They sold 2-3 lakh crores worth. And now when they want to buy back that same quantity,
it's coming at 21,000.
Yeah, so they have to pay that price. I think we earlier discussed that. So I think, but then I think real fun will be that money will be taken away by the companies. You see how many IPOs are there, how many block deals are happening, how many private equity exits are there. So now money will, at some level, promoters will find it attractive for the unlisted companies to get listed companies to go for aggressive expansion and create infrastructure and give a good kick start to the private capex cycle. So my sense is that we are in a fantastic, government is having fantastic time in getting the tax, and hence they are blowing it in the infrastructure. And if the private capex starts, they'll get more taxes. And so I think,
we are in a virtuous cycle.
Yeah, so that kind of thing looks right. And valuation is also at about, see, another thing which can go wrong in the market is that are you crazily priced? So yes, at 4 trillion to a 3 trillion or GDP, we are fully priced, but still okay.
Okay. No, I take your point, but who are the beneficiaries? I mean, now to come to your study itself, before I come to the hockey stick, you say that PSU banks are one party that look, ripe for gains.
It's not only PSU banks for sure, because they have been beaten down so badly, and they have size, they have brand equity, their distribution, they have the deposit franchise. So everything goes for them, just that their past is very bad. So obviously market will remain skeptic about what will happen in the future. But since the management style has changed, in the sense that interference from Delhi has almost gone totally, and they are being managed in professional way. Credit cycle is very good. Credit cost cycle is kind of very favorable. Banks are actually, they have a net positive, I mean their recovery is more than slippage. Apart from, so this is a cycle. I mean generally these are the typically end of it. See, 1 year you have more recovery than slippage. Almost you are coming end of the cycle. So I don't have good understanding of where the economy is, I mean, is it getting worse?
Last time the good cycle lasted for 10 years. You remember they started cleaning up in 2002, 2003. And then till 2013, the banking cycle.
But 2007-8, I think it just peaked out. It is in stock market. So it was about 5 years, 6 year kind of thing. We started in 2021. We are already in 2 years. I hope we have 3-4 years in our hand for the grand finale.
Fair point. Now let me come to the large caps. It's common knowledge now that the small caps and the mid caps have done very well. It's the large cap index which is lagging. Do you think that therefore it is safe to go with the large caps? And in particular, I think we are running along, when you speak, the fastest in the last 5 years. The largest wealth creators. Now you point out in one of that, HDFC Bank for the first time is not there in the fastest or most consistent. Biggest. So do you think its time has come? Should we therefore look for those kind, or because it's not there, don't go there?
See, this is a proper bull market. Everything is going perfect. You have to be a good investor. Being good investor doesn't mean mid cap, small cap, large cap. It is about finding the right idea. Right investment idea at reasonable price. So if you're finding a big bank to be very reasonably priced at less than 1 peg or something like that, HDFC, ICICI, Kotak, whatever you like, that's also a good idea. But if you're finding a smaller bank in the same parameter even more attractive, you must buy that smaller one also. Or there are some businesses which are fundamentally mid and small. Like small is also not anymore small. Small is now I think about 18-20,000 crores. The biggest small is about 18-20,000 crores, and mid is the smallest mid is 18-20,000. So we are not talking about some
small like
So you have now enough size. So let's not discuss this SEBI classification for investing. Investing must be at the. It's unfortunate that because
it should be cap agnostic.
This cap has become very important because the mid and small index has done 30-40%, whereas the large cap has done 12-13%. It is purely because of the movement of the FI interest in India. They typically buy and sell large cap, and since they were absent, in fact they were selling, the large cap remained depressed, and all the money went into mid and small, and they kind of so. My sense is that one should look for good ideas. Because large cap has say 100 companies, mid cap has 150, but small cap has thousands.
Yes.
So you'll always get some spot where you'll find ideas. So I think you should chase a good idea, and this study is actually a framework to find those ideas.
Okay, let me come to that study. You're speaking about hockey stick returns.
Yes.
And you specifically refer to companies like Astral, Bajaj Finance, Ratnamani Metals, Tata Elxsi. I hope I'm quoting the names right.
Yeah.
Now, those are the hockey sticks that have come.
Yeah.
Where will you look for the next hockey stick?
Yeah, so that hard work has to be done by the investor himself. Okay, I have given the framework. See, we read the book, the Hockey Stick Strategy, Strategy Beyond Hockey Stick. So that's the book. I think fantastic book on strategy, very practical. And this is a way, if you read the book and figure out. So they have talked about concept of economic profit. The first thing is economic profit. And as a chartered accountant, we have done accounting, and there we talked about almost net EPS and net profit. But very simple thing is that when you do net profit as per accounts, you don't charge for the equity. You charge for debt, you charge for everything.
You don't adjust for cost of equity.
So if you just take instead of going through some alpha beta, if you just take the cost of equity as 10%, because last 10-12 years return has been about 10%. So you take 10% for all the companies. You arrive at, so we have given an example of a company like I think IOC and Nestle or something like that. So one company uses 1 lakh crore of equity and profit is say 5,000-6,000 crores. So actually there is economic loss. Yeah. Whereas other company makes say 2,000 crores profit or 2,500 crore profit, but uses hardly 2,500 crores. So economic capital charge is about 250 crores at the rate of 15%. So his economic profit is 2,250 crores, whereas the other guy, though looks giant, is actually economic loss. And that's why market has punished also.
Yes.
Market cap of the smaller company is much bigger than market cap of the large giant company. So that to some extent, in market you cannot explain all the difference in valuation, but yes, this explains what market values. So we are not practicing it, but market is practicing it somewhere.
No, but if by your logic of economic profit, you have given us a list. I'm trying to find that in your list. The list of companies with highest economic profit and not accounting profit also includes SBI, ONGC.
Yes, I think
so you think their day has come?
TCS is the largest. It's about 30,000 plus crores of economic profit. Then, so we have given entire Nifty. The entire list of where really they stand in economic profit. What happens is some of the companies like say Reliance doesn't show as an economic profit company, but they are amalgam of 3-4 large businesses. Yes. So they are making tons of money, economic profit in their original business, but they are probably investing in Jio and retail and whole lot of other things. So that's why the fused company looks to be like not making economic profit.
But the petrochemical or the...
so it's a sum of profits kind of situation. So one has to analyze. But basically, when you are looking at single stream companies, simple companies, their economic profit as a concept is worth pursuing. And what this study is about, the book is about, is that you must measure the success of the companies in terms of economic profits. And economic profit is distributed in a power curve situation. So it goes like this. So the 80% of the economic profit is in the top quintile. So 20% of the companies, and 80% of losses are also in the bottom quintile. So you have, and the middle 300 companies, they are all gone nowhere types.
That's so you have to look at companies migrating from
so what he says, the strategy is you find a company at the middle and what it takes to go from middle to the top quintile.
Okay.
That journey of hockey stick. When they do hockey stick earnings growth, market gives them with the re-rating super hockey stick returns. Okay, so economic profit, the measurement is economic profit, and the way to go about is there are 3 steps he's saying: endowment, trend, and moves. So what is endowment? So any company starts its journey with some kind of endowment. So they have competitive advantage, they have brand, they have distribution, they have people, they have businesses, relationships. Those are all starting point.
Yeah. The endowment of the company.
Yeah, but there is no tailwind in the business. Yeah. So the company will stay there only. There cannot be better person than me to talk about the benefit of trend. I'm telling you, in capital markets for last 10-12 years, we've done so much of action as a corporate action. Whatever is possible, we have turned the mountain, I'm telling you. and yet nothing much happens. I mean,
Yes.
we're doing well.
You saw
Yeah,
this,
during 2008. See,
the decade of 2011.
Yeah, so we have a lost decade, despite massive action when I look back.
Yes.
But nothing happens because there is no trend. Now from 2020, the trend has started. We are literally 10x in 3 years in terms of profits.
Absolutely.
So the power of trend is massive. Every business is
The
different.
trend is whom now? You just spoke about government is into capex.
Yeah.
If they spend the
Yeah.
money and private capex
Yeah.
comes, so do we look for capex companies?
You have trend and trend all over. Like there are multiple trends. Like you play Scrabble. I mean, your opponent cannot see what trend you are seeing in the building. It's like that. There are so many trends. The whole universe is full of trends. Business is full of trends. So something is happening in terms of IT, something is happening in AI, something is happening in real estate demand, something is happening in the cost structure of cement companies, something is happening in pricing of cement companies. So you have to find that trend which is on which you can bet. And trends are short-term, long-term, cyclical, secular. All sorts of things are there about a trend. Just think about it. You can keep thinking about trends. But without positive trend, so it's like a escalator where a person is running. On top of it, you get a skeleton, and then you go at the speed of he himself plus a skeleton. And when the company's trend is headwinded, you are as if you are trying to come down, and the skeleton is going up.
Yes. But still, if you would pick up the top, I know there are many trends that you can pick up. What would be the top, say, 2 or 3 trends that are staring at you in the face?
So the newer ones are like, say, rise of capital market, like rise of retail.
The capital market
that's very close to me. So I am saying that. Second is the build up in the savings boom in India from 10, 12 trillion dollars in last 25 to 125 trillion dollars of savings.
So that would be mutual funds or banks?
Now this is where one has to figure out. Banks, of course, will be beneficiary because bank is a scale economics, and you need. So they are going to be very large beneficiaries. Second, of course, all the asset management companies, broking companies, your CDSL, NSEs, BSEs, whatever comes on the advisors, all the wealth will be so much. You need all the global wealth managers will be sitting here. I'm telling you, yes, they'll all open shops.
Yeah, so certainly financial sector, capital market.
So that's one part of it. The second is real economy. Your every day you keep coming out with a newer, now capex boom.
Capex.
So government led capex boom, and now private sector is just knocking the door. So the capex boom will happen. So all kinds of
real estate.
Real estate is another one which has almost 1.5 decades of kind of absence.
I know,
from 2008 to 2023, and now I think they will have very prolonged.
Giant
if they play their cards well. See, they also need. That's where the corporate move comes. So there is the endowment. They have everything. They have brand. They have opportunity. Everything. And trend also there. Then after that, you have to play your cards well. So the managements have to remain very disciplined because it's very easy to be taken away by some crazy greed, over leverage.
Over leverage or overprice. Or over
leverage, doing some nonsensical projects, not doing something what the market wants. So being ahead of the market, producing right quantity, right product, and giving to the market. I think it's not a 5-10 years. It is multi-decade trend for them. It's a very large industry.
You have vetted our appetites to read the report in full. I have read it. I have read every word of it. But I would, very strongly recommend that those who are serious investors should, go ahead or of course you can fall back on mutual funds. You can fall back on the Focus 35 or the Focus 45 as you please. Thank you very much, Raamdeo Agrawal, for discussing your report and for joining us on what's a really big day for the markets. I think what stays with me is that the biggest of all bull runs is
grand finale is still ahead.
Grand finale is still ahead. Those are the words that we should carry from this interview. Thank you very much for joining us on this very special chat on Bazaar. After a break, Chartbusters.